The topic is market mechanics, and you have enough conversations or frequent conversations with people about they've lost more money than they can make back. They can't tell their wives. They're not sleeping at night. They don't understand how they blow their account up once a month, and you start to wonder why is the system like that? Well, capitalism being what it is, everybody has access to capital markets, but in a better arrangement, a lot of you wouldn't be allowed. Just like the medical community or anything else where you have accreditation or degrees, you need to be able to hurdle the levels in order to perform. And that's not like that. So anybody with a few bucks and a shot can take a crack at this. And so, but the analogy that you got to think about is, we think of like this. Think of this like real vicious man-eating shark here. All right. So this guy is the institution. He's the bank. He's the exchange. Here, this is you. This is retail and very small institutions. If you don't think that the big institutions know exactly what your favorite market timing model is, your favorite technical indicator, where your stop is, if you think this is somehow some level playing field, then you are sadly mistaken. And so that is what most people don't understand. So once you learn how to trade, what happens is the first thing that you notice, so when you're talking about being able to adequately or consistently analyze the primary two dominant phases of market movement, which is expansion and contraction. So we have expansion and contraction. When we can analyze that properly and we can get price points, low risk price points for explosive moves directionally so that we can eliminate risk. The first thing that you understand is what am I trading now becomes extremely important, and the mechanics of how I can get in and get out of that become extremely important. And so a lot of people ask me, well, you trade stocks, you're an equity trader. Yes, I am. I don't trade commodities. I don't trade Forex. I don't trade, cryptocurrencies. None of that, because those types of markets are extremely competitive. And they also are broker-dealer type markets. So let's take a look at one of the issues with Forex, just for sake of argument. So Forex there's no last price, meaning that there's no agreed upon legitimate exchange which produces a last trade. Now what that means is there's no exchange disseminated data that you can act upon. It's all going to come from the various broker dealers and the banks. In fact, I've worked with students that trade Forex on, the meta platforms, whatever they are. And I have a buddy that does it in the UK. His data is different than someone in San Francisco. So that's a problem, because in order to be competitive, as we've seen with this, with the dynamics of moving from expansion to contraction, you need to make sure that your institution and your levels are sound and that you're all looking at the same thing, so you have a fighting chance about guessing that next guy. So if we're talking about like these spot markets where we just have this moving bid-ask spread up and down, especially with the FX pairs like the Euro USD, whatever it is. This is moving all over. This is a moving bid-ask window that can be greatly different depending on the platform and the data and the banks that are filling orders in there, okay? Because there is no last, there's no exchange disseminated last price upon which you can base your analysis. That's extremely important. That's what I do all day long, the last price. Without the last, I can't do it. It makes it absolutely, frankly, unfair. Okay, so same thing with crypto. So these are all markets that are sexy and hot, and I know everybody wants to analyze them and look at them, but just because you get chart data for a certain equity or security does not mean that the market mechanics of managing that trade, analyzing it, and effectively manipulating price is going to be there. That's extremely important to remember. Okay, next thing we want to talk about, even when it comes to stocks, there are still lots of pitfalls, and we're just going to take an example of like these exchange rules. Okay, so for example, on the NYSE, you have what's called the NBBO, the National Best Bid and Offer. Okay, so that's the bid and ask spread. Okay, so the NBBO, now according to the NYSE, with those rules, the specialists and the market makers, now depending on how the orders are routed, they're going to have to satisfy the orders within that NBBO in terms of limits and market orders before they can trade outside of it. So you can't stick, they can't move that arbitrarily against you before those orders are filled. So once they're queued, they're queued. It's reasonably, quote unquote fair. But let's see, when we get over to the NASDAQ, now that just flies out the window, because the NASDAQ doesn't have an NBBO. It just has a market maker system. Okay. Now, this is a lot like those Forex markets where this bid-ask spread now is moving all around. So what happens is, when your order's queued, they can easily move. They can move that bid-ask spread to drag you around. Happens all the time. Another thing that happens with the NASD is that bid and actually stop prices. So we're just going to talk about stops. Stops, for example, are triggered on the bid and ask, not the last. You would think, in a fair market, the price would have to print on the exchange. That's that way in New York. With the NASDAQ, stops are triggered on the bid and the ask, meaning the price does not have to print there in order for them to drag you down. So if you don't know how to effectively place these orders and manage your levels, you're just going to be a bone to be chewed. Okay, so those are just a few of the things that you have to understand about the mechanics of the markets that you're trading. And one of the easiest way to learn how to trade, the easiest way to learn how to second guess price and really get a consistent approach to it is definitely U.S. domestic equities. And I know, everybody, stocks aren't the sexiest thing, but it's not crypto. It's not some new, whatever. It doesn't matter. It's competitive. It's much less competitive than the index trading. It's easier to get in and get out. You can find markets where the mechanics are very, very desirable. My price levels are spot on, so I know I'm competing with the proper last at the proper time, and I can bet on that. And I can bet on it every day, and I do. And so my suggestion is, no matter what you're trading or what you're looking at, a lot of my students really struggle to get consistent in whatever they're trading simply because they have disavowed the mechanics of the markets that they're looking at, and they think that any old price chart on the internet is just as good as another. Man, that is just not the case. All right, so if you want to learn more about this, there's a link in the description below. You can join my free training. Learn the markets, learn how to trade, learn how to get explosive moves from your price points in the markets with the best mechanics, everybody. All right. Thank you very much. My name is Frank Bunn, and I will see you next time.